Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Origin story. Downgrade. This article was written by Deep Value Investing. Summary. Pause. I haven't seen Intel's DCAI segment constrained by supply in a very long time. Even though the company is missing revenue in Q1, I think this is a positive development. Intel beat DCAI expectations, $4.7 billion versus $4.43 billion on Granite Rapids demand, but buffer inventory depletion and a wafer mix shift delayed supply improvements until late Q1. Management said revenue would have been higher with more supply. Q1 2026 revenue guidance was $11.7 to $12.7 billion and non-GAAP EPS 0.00 versus the street's $12.51 billion and 0.5 cents consensus. Foundry is still a cash sink. Intel Foundry posted a $10.3 billion operating loss in FY25, with external foundry revenue limited to just $222 million in Q4. Despite being cheaper than TSMC on a forward EV sales basis, I'm waiting for Q2 evidence of yield and margin improvement. Expectations for Intel Corporation, INTZ, were elevated heading into Q4 earnings, particularly for the data center and AI segment. This is the first time in many years that I have seen the DCAI segment constrained by supply and not demand. The street was modeling roughly $4.43 billion of revenue for the DCAI segment. Intel obliterated expectations after delivering $4.7 billion, up 8.9% year over year, noting high demand for its server CPU, the Granite Rapids Xeon 6. Unfortunately, the market looked past the demand point and decided to focus on the supply issue. In Q4, buffer inventory was mostly depleted, and the wafer mix shift towards server production would not reach a high output until late Q1. This led to a very soft Q1 2026 revenue and gross margin guidance, below the street's expectations. Even though shares are 15% cheaper than yesterday, I decided not to buy the dip yet. Below, I explain why. Expectations were high heading into Q4 earnings. In my view, the market had high expectations for Intel's data center AI segment. Interestingly enough, the company obliterated expectations, although disappointed from a guidance perspective. The street projected $4.43 billion in revenue for the data center AI segment. Results showed $4.7 billion, up 8.9% year over year. Within DCAI, some analysts, KeyBank, were focused on the demand for Intel's server CPUs, particularly the Granite Rapids, Intel's Xeon 6 server CPU line. Well, it turns out that KeyBank was right, although the market didn't react positively. Management confirmed that the buffer inventory was depleted, and the wafer mix shift towards servers won't come out of the fab until late Q1. As a result of the supply constraints, the revenue guidance for Q1 2026 was quite disappointing. Intel guided Q1 revenue $11.7 to $12.7 billion and non-GAAP EPS 0.00. The street was looking for $12.51 billion in revenue and 0.5 cents in EPS for the quarter. On top of that, CFO David Zinsner noted the following remarks during the Q4 earnings call, which didn't help improve the sentiment. Emphasis added. Revenue would have been meaningfully higher if we had more supply. While the market continues to benefit from more power-efficient CPUs, stimulating a refresh cycle, all indicators point to the growing and essential role CPUs will play within hyperscale and enterprise AI data centers as inference-driven AI usage expands. According to the call, supply should improve from Q2 onward. The problem that I see is that Intel's missed units are likely to become permanently lost if customers qualify alternatives. And given Advanced Micro Devices Inc.'s AMD and NVIDIA Corporation's NVDA dominance in the data center space, I believe there are plenty of better alternatives out there. Margins are shrinking, and yields are still below targets. The next metric that disappointed investors was gross margins. Again, the company obliterated the Q4 gross margin expectation after reporting 37.9% versus 36.5% guided. I believe the beat had to do with lower inventory reserves than initially expected. However, the guidance for Q1 was a big disappointment, Intel guided Q1 non-GAAP gross margins of 34.5%. That's a 340 bps sequential decline. Zooming out, the long-term trend in gross margins is not particularly attractive. I believe the main headwind to margins is the yield of the new 18A process node. Back in Q3, CFO David Zinsner made some remarks that made me sweat during the earnings conference
Hey viewers,
call.
like and
Emphasis
subscribe to
added.
our channel. We'll
Yields
keep
are
bringing you more
what I would
insightful
say
stock
the yields
analysis.
are
It's going to
adequate
be
to address the
wild.
supply, but they are not where we need them to be in order to drive the appropriate level of margins. And by the end of next year, we'll probably be in that space. And certainly, the year after that, I think they'll be at what would be kind of an industry-acceptable level on the yields. In Q4, CEO Lip Bhutan made the following remarks about margins. Emphasis added. In the short term, I am disappointed that we are not able to fully meet the demand in our markets. My team and I are working tirelessly to drive efficiency and more output from our fabs. And while yields are in line with our internal plans, they are still below where I want them to be. Accelerating yield improvement will be an important lever in 2026 as we look to better support our customers. At the very least, I want to see a slight improvement in yields this quarter. How can you tell yields are improving? Well, I would closely monitor the Q2 2026 gross margin guidance versus the realized margin in Q1. As for the Panther Lake, I admit I was impressed to see that the Intel Core Ultra Series 3, i.e. Panther Lake, is now expected to power more than 200 OEM designs. At CES 2026, Intel announced that the Core Ultra Series 3 systems will be available globally starting Jan 27, 2026, with more designs through H1 2026. Overall, I feel optimistic about the Panther Lake, given that at CES, Intel highlighted a performance of 50 NPU tops. In comparison, Microsoft's Copilot Plus PC requires only 40 tops for its Edge AI features. However, even if the performance of the Panther Lake can be enough to run AI on the edge, if yields are not improving, the gross margin problem will persist and keep pressuring shares. Foundry's still under pressure. Let me start with price action first. Since Q3 earnings, up until the release of Q4 results, Intel was up 40%. Almost 10 percentage points of that came from the jump on January 21st, on pretty much no news, aside from the macro backdrop improving, after Trump said in Davos he is not planning to take over Greenland by force. At the time of writing this article, shares are down approximately 15% from the close on January 22nd. Yet Intel is still the second stock in the foundry space in terms of 12-month returns. Bear in mind that over the same period, Intel Foundry reported an operating loss of $10.3 billion, slightly better than in 2024, but not enough to call it a turnaround. I am not convinced that Intel is out of the woods with its foundry segment. According to Reuters, NVIDIA tested the 18A, but decided not to go forward with this manufacturing process. On the positive side, the company disclosed $222 million in external foundry revenue during Q4, mainly driven by projects with the U.S. government and the deconsolidation of Altera. From a guidance perspective, management guided overall Intel Foundry revenue to grow double digits sequentially. So, the improvements in the top line are fine. The issue that I see is concerning the bottom line of this segment due to the yield problem on the 18A. On timing, management reaffirmed in Q3 2025 the goal for Foundry to reach run rate break-even as it exits 2027. They didn't reaffirm this target in Q4. However, management said that Foundry met key 18A and 14A milestones in the quarter. Improving yields is a slow process, and until 2027, I believe the risk of more sell-offs like the one we've seen on Friday is high. Valuation. Given the cash sink problem, i.e. Intel Foundry, we can't use the forward PE multiple, given that the street expects a negative EPS next year. That said, on a forward EV sales basis, you may be surprised to know that despite the massive run in the last 12 months, Intel is cheaper than Taiwan Semiconductor Manufacturing Company Limited, TSM. Conclusion. I find it quite strange that the market looked past a key point. Data center demand was so strong that the company couldn't keep up with supply. Up until Q4 results, I never believed that Intel would be supply constrained in its DCAI segment. My concern was always from a demand perspective, given the dominance of AMD and NVIDIA in the AI data center space. I am glad that Intel has this problem. and I think the setup from Q2 onwards is favorable if the company can ramp up production and meet the high demand for its data center server CPU, Granite Rapids. However, until then, I prefer to remain on the sidelines. From a price action perspective, I believe shares could be in for another 10% drop until they retest a long-term uptrend. Now, a $5 drop is not enough to downgrade to a sell, and given the excitement around this stock after the NVIDIA